Let's get to the Fed here because rate hike expectations are coming in, as you know. Let's bring in Steve Leisman for more. Steve.
Hey, Melissa, the decline in yields, which I think is pretty sure brought on by a flight to safety, is prompting a rethink of the outlook for the Fed. 50 basis points, that's out for March now, and more doubt has crept in about any hikes beyond 3. But I just want to say investors need to be careful about making calls on Fed policy from big flight to safety swings. Just because a lot of people are scared to put money in treasuries doesn't necessarily change the Fed's calculus. But take a look here. Fed funds nevertheless trading with a 100% probability of a March hike and only a 10% chance of that hike being 50. There are high probabilities for quarter-point raises in May and June. But that's where the certainty ends. Probabilities for July and November, they're approaching only 50%. For the first time in a while, the 6 hikes now priced right out. All this comes with that sharp decline in bond yields you guys have been talking about. 10-year since the Ukraine invasion, fallen from 2% to now around 172. That complicates the Fed's job. It's looking for tighter financial conditions to cool the economy, and now it really wants higher rates. Now it's getting lower rates. The war further complicates the job by pushing up oil and other commodity prices, while the Fed otherwise, it might back off tightening because of geopolitical uncertainty. Well, the move in commodities forces their hands. And just one other thing, get Tim to get his friends on the phone. I don't think it's crazy to think you have a lot of money in Russian assets looking for a new home. Maybe they landed in treasuries and helped bring those yields down today.
Yeah. Steve, it's Karen. Thanks for being on.
Well,
so
look, I think you've got a case,
rate hikes,
Steve, where if you think...
Oh.
Karen, go ahead.
Thanks,
one at a time. One at a time,
okay.
kids.
So we see, a couple of rate hikes, whether it's 4, 5, 6. I don't know. Does that matter as much as QT? And is QT now postponed? Is it off the table for this year? What do you think the Fed is thinking about that?
Well, as I've made the asterisk that I put up on all these answers, I don't know what it means for values. I mean, you guys are the experts on that. I mean, there's stuff that was trading crazy, and then the Fed was going to comes in and says it's going to hike rates, and some of that stuff comes down. You asked about the economy. I have no problem with a funds rate that's 1.5%, and the Fed backing off the $9.9 or $9 trillion balance sheet. I don't think that's a problem for an economy sporting a 3.9% unemployment rate and with a 7% inflation rate, where growth is going to be above trend or thought to be above trend for this year. I don't think, Karen, that's a problem for the economy. You just have to figure out, are those high-flying stocks with a 1% funds rate rather than 0? Are they not worth 30x? Or are they now worth 20x? You got to figure that out.
Steve, it's interesting that, Jerome Powell is going to be on Capitol Hill, and this comes at a time when there is some commentary from other central banks around the world to the effect of this war is now a major concern, and maybe we cool off on the hiking, on the tightening, until we finally see the assessment. Do you think there's going to be pressure on Powell to sort of reiterate or echo those sorts of sentiments, or more pressure because gas prices are going to spike and the inflation boogeyman is looming over him?
I think that's an excellent question. What I'm trying to puzzle through, Melissa, is does somehow this war reduce demand and consumer demand? Does it cool the economy by itself? Now, I'll be listening very carefully to how Powell thinks about oil prices, because it's really a double-edged sword. Higher oil prices are a tax. They drive up the inflation numbers, but a lot of times it comes out of other places, especially when it gets high the way it is right now. So it could be reducing demand. I don't see a lot of ways, when I look at the aggregate impact of the GDP of Russia and Ukraine on the rest of the world, I don't see a big impact on the U.S. I see a bigger impact in Europe, which is a second derivative impact on the U.S. So I think the Fed's going to go about its appointed rounds amid the status quo currently of this war. If something happens that dramatically reduces demand, if Russian oil is cut off, then I could see the possibility of maybe the Fed backing off. But I don't see them backing off given the inflation rates, given where they are, and frankly, given the strength of the economy.
All right. Steve, thank you. Steve Leisman.
Pleasure.
Pete, how are you thinking about all of this?
Well, Steve mentioned the strength of the economy, and that's certainly something that I think we're all watching. We talk about oil as well, obviously, this demand in it. Let's all remember this now. This oil move started long before Ukraine, Russia, and all this has started to bubble up to where it is now, where we're actually referring to it as a war. So I think that makes things very, very complicated and very interesting to see exactly how Powell and the Fed wants to navigate through this. Obviously, they've taken some things off the table, but you know, I think it's made it that much more difficult for them. There's no doubt about it, and I think they're really going to have to be measured here, and maybe it'll give them an excuse to step back again if this starts to escalate, especially as Steve was just mentioning, we start to see something happen with oil and with what's going on with Russia, and then all of a sudden the demand is there for even more, and yet there's not enough. That's something that I think they're really going to have to be. It complicates everything.
Let's play this game. I lay out the scenario, and you tell me, Tim Seymour, what the market reaction would be. Powell goes on Capitol Hill tomorrow and says and comes off as more dovish because of the war. Do markets go up or markets go down in response to that?
Markets go up. Look, because right now that Fed put, we all probably a similar, or I'll take the Fed put down 20% from here. I do think we have the view that the Fed has to move regardless, and so look, a more dovish Powell is what the market is been reared on, and I think that's what they want to hear.
You don't know my answer?
It's down.
It's down.
It's always down.
I just want to be really clear. But no, I gave you kind of eyes in the break there.
Yeah.
Listen, it's down because, A, the Fed loses their credibility. They already said what they're most focused on, which is inflation. Everything that's going on geopolitically only exacerbates those issues of inflation. And I just want to say one thing. I take issue with this thing that the economy is doing so well, that it's so good. I mean, we have trillions of dollars of fiscal and monetary over the last couple of years. The economy was already slowing in 2019 before the Black Swan pandemic here, and I believe that the 10-year U.S. Treasury yield was at 1.53 just a couple months ago because it was signaling that the economy wasn't as strong as maybe that really great unemployment number was speaking to. So to me, I just don't really see it here, and I don't really see too many ways out right now for the economy, especially given the fact that the only thing the Fed can do that thinks they're going to help is kind of lose their credibility.